All right, good evening, everyone. Thank you for joining us today for our webinar on deflating your fears about inflation. I'm Sarah Chia from the Bond Supermart team, and today I'll be your host and moderator. So for the first half of the year, and even up till now, fixed income markets have been fretting about these growing inflation concerns, and it all kind of started when commodity prices surged and your shortages started to surface earlier this year. Then you had your fears continuing to build due to the surprisingly high CPI numbers, the Fed's response towards that, and then the rapid surge of US Treasury yields. So given how much interest rates have fallen last year, I believe most investors accepted that interest rates were unlikely to keep falling, right? But I think most investors were not prepared for Treasury yields to begin rising again at this pace. So that has led to the fear in fixed income markets. And today, through our webinar, that's what we'd like to discuss. Okay, we want to help you deflate your fears about inflation when it comes to the fixed income markets. But first, if you haven't already, please download a copy of our second half 2021 recommended bonds report. You can go to the link here, or you can scan the QR code here. And if you've followed our previous editions, we read our past editions of our recommended bonds report, you'll notice that we've actually revamped our report. So we have now categorized our best picks according to sectors like your banks, your commodities, your real estate, USD high yield, etc. Okay, and hopefully this makes it even easier for you to select bonds and to ultimately find one that suits your needs. In this issue, we've identified 25 issuers and 36 bonds that we're very positive on. Okay, and you'll be able to read our market outlook and our issuer commentary all in there. So let us know what you think of the new revamp of our picks. You can always contact us via Facebook. Okay, you can search for us, Bond Supermart, and share your thoughts with us there. Okay, so for tonight's agenda, we're going to have two main sessions. Okay, in our first session, we're going to talk about the impact of inflation on bonds. We're going to have a panel discussion for that. And then we'll address the biggest concerns that investors have. Things like, what is happening with inflation? Okay, what are the implications of inflation? Like everyone keeps talking about it, right? What does it really mean? What is it going to impact? How would inflation affect your current holdings if you are a current bond investor? And very importantly also, the number one question we get all the time is, what do I buy now? Okay, and then after that, we're going to transition to our second session where each of our analysts will share with you the top picks for the second half of the year. And then finally, we're going to have a Q&A. We would love to hear all your questions, so please feel free to send your queries into the Q&A channel. Okay, and now let me introduce our speakers. Okay, first we have Dexter Tan. He is a senior fixed income analyst with IFAS Singapore. Dexter was previously with NUS Risk Management Institute as a credit research associate, focusing on researching distressed issuers and corporate default situations. Okay, he was also at Eureka Hedge and Phillips Securities, and he currently holds a master's in statistics from the National University of Singapore. We also have Tan Churan with us today. As a fixed income analyst with the research team at IFAS Singapore, he has also been part of the IFAS unit trust and macro teams prior to joining us at Fixed Income. So if you find him familiar for whatever reasons, that's probably it. Okay. Sang Wai Ki is a fixed income analyst at IFAS Hong Kong with a focus on Asian Hong Kong dollar and US dollar credits. She was previously with Hutchison Telecommunications as an assistant credit analyst. And last but not least, we have Jackson Chan, our assistant manager of fixed income research at IFAS Hong Kong. His main focus is on studying Asian high yield credits, especially Chinese real estate and casino sectors. Okay, so for our first question today, we will have Dexter Tan, our senior fixed income analyst, share his thoughts with us on what's happening in today's environment. So over to you, Dexter.
Okay, thanks, Sarah. So for the next couple of minutes, we'll be discussing on inflation. And inflation is a hot topic right now, as it's prevalent in many discussions among many market observers and economists. But before we answer this question, what's happening with inflation, maybe we can ask what is inflation. So inflation is basically a measure of the price increase of goods and services in the economy. So how do we measure inflation? Well, it's a well-known indicator of inflation is the consumer price index, and it's made up of many components such as food, accommodation, transport, used vehicles, and gasoline prices. So these consumer price indexes are defined differently in various countries, and they have also a reference year. So maybe they start at 100 in a particular year, and then maybe in the next year they will go to 102. So inflation or the change in prices for that basket of goods would have increased by 2%. So to measure inflation, we usually take the change in the consumer price index on a year-on-year basis. So what's happening with inflation? So there are many, we can look at inflation in different parts of the world. For example, here we have a diagram of the United States. So one of the measures of inflation is measured by change in US PCE. So shown on the right, and the US PCE core price index shown on the left, which excludes food and energy prices. So the one that excludes food and energy prices is the blue line, and the yellow line is basically the US PCE. So US PCE, or personal consumption expenditure price index, is also the inflation measure that is used by the Federal Reserve. So we can actually draw a few observations here. So firstly, if we look at the yellow line and the blue line, we can tell that first that energy and food prices tend to be volatile, and which is why we see that the core price index is smoother, as you can see in the blue line. And secondly, if we look at US PCE price index, it's actually risen to the highest level since 2009. I mean, if we draw, a line here, so we can tell that this level is the highest level since the 90s. And then here, if we draw for the yellow line, it's the highest level since maybe into the Great Financial Crisis. So some of us think that maybe if inflation carries on at this rate, if we continue to see higher inflation moving forward, then perhaps we would see a hyperinflation scenario like what happened with Zimbabwe and Venezuela. But if you look at the numbers, I mean, 3.9%, and if we look at 3.4%, so these are actually very low numbers. So it's very different from a hyperinflation scenario whereby it's unofficially defined as something which has a 50% change in consumer prices. So part of the inflation in the US is partly driven by high gasoline and used vehicle prices. So here we have gasoline prices on the left in blue, and then on the right in white, we have the prices for used cars and trucks. So as you can see, prices have increased by 56% for gasoline prices, and for used car prices is up by 45% on the year-on-year basis. So these are actually very large numbers, and it may be the case that these components, which are components of the consumer price index, are the reasons that why we are seeing such high headline inflation numbers in the United States. So for Europe, inflation in Europe is measured by the changes in the Harmonized Index of Consumer Prices, or the HICP in short. So unlike the US, the picture in Europe is somewhat different from the US. So firstly, we are able to tell that the rate of inflation is declining or decreasing over the years. For example, in the 1990s, prices were maybe around 3%. I mean, they increased by 3% on a year-on-year basis. And then maybe in 2007, we had a higher rate of change in prices. But recently, if you see here, it's about 1.9%. And then if we look at the white line on the chart on the right, which excludes unprocessed food and energy prices on a year-on-year basis, it shows that inflation is also falling, but it's actually very low at 0.9%. And what this demonstrates is that inflation is not really an issue in Europe, but I think the risk of deflation is higher in Europe. So in Singapore, we have the consumer price index. It has increased by about 2.4% increase on a year-on-year basis, and core inflation by the MAS, which excludes private transport and accommodation prices, has increased by only 0.6%. If we look at the general trend over the past couple of years, we can tell that that is pretty much similar to what we are seeing in Europe, and less likely to what we are seeing in the US, whereby inflation in the US is somewhat like picking up, but I would say I think inflation trends in Singapore is somewhat muted. So what is the outlook for inflation? To answer this question, maybe we can look at what the central bank heads are saying. And according to our forecast, which is our house view, is that in the central scenario, which is the more probable scenario, that core PCE is likely to be 2 to 3%, and policy rates would be hiked by 3 times by the end of 2023, and the 10-year US Treasury yield would range around 2 to 3%. So in the less likely scenario, in the hawkish scenario, the core PCE is expected to exceed 3%, and then we have 4 to 5 rate hikes, and then possibly the 10-year US Treasury yield could rise to about 3 to 4%. So according to the central bank head, Chairman, US Federal Reserve head, Jerome Powell, in his latest monetary policy report to the US Congress, he said that conditions in the labor market have continued to improve, but there is still a long way to go. Inflation has increased notably and will likely remain elevated in the coming months, but it's actually boosted by temporary base effects. And the strong demand which we are seeing and the production bottlenecks should partially reverse as the effects of the bottlenecks unwind. And if you look at the US Congressional Budget Office, so this is the office that is in charge of providing a US Congress with objective, timely information, analysis, and estimates related to US economic and budgetary decisions. So according to their forecast, and you can get this from their website, you can see that their projections, they expect inflation to grow at a slower pace all the way perhaps until next year, so early 2022. It will grow, it will still continue increasing, but possibly at a slower pace. So you can actually Google this, but according to the LA Times, the US CBO, or Congressional Budget Office, analysis is actually regarded quite good or even better than others who are doing similar work. So their economic projections are actually quite favorable against other outfits. And their long-term budget estimates, according to the LA Times, has been fairly accurate. So this is pretty much in line with what our house view is, that is inflation is possibly between 2 to 3%. So you can draw a line here. So it's possibly between 2 to 3%. So according to the CBO, they also have projections for the 10-year Treasury yield. So they also expect higher yields moving forward, and is expected to go on an upward trend in the upcoming years. So it's also very much in line with what we are forecasting for, according to our house view. So what about Europe? I mean, is inflation structural or transitory? I mean, if we look at what Christine Lagarde, the ECB president, has said, so inflation has picked up, although the increase has mostly been temporary. The outlook over the medium term remains subdued. Measures of longer term inflation expectations have increased, but they remain some distance from the 2% target. So this is based on their monetary policy statement on 22nd of July. So what about Singapore? Again, if we look at the latest statement as of June, this is from the MAS managing director. So they say that domestic cost pressures will be muted given the lingering slack in the labor market. The CPI in 2021, which is this year, is expected to be about 1% to 2%. So if you recall earlier, I think the slide says it's about 2.4%. So from 2.4% to end the year at 1 to 2%, I think inflation would probably grow at a slower pace. So and one of the reasons for the sharp rise in inflation recently is, according to them, is that it's due to sharp rise in COE premiums. So as the base effects fade, the CPI is expected to ease in the second half of this year. So one of the things that we like to address is interest rates affected by inflation alone. So the short answer is that no, it's actually dependent on also the job market. I mean, the central bank, when they make decisions on interest rates, they also look at unemployment. So here we have unemployment in the United States, which has increased, and you can tell that it is at a very high level since for many, many years. So this is long-term duration unemployment, meaning people who are actually unemployed for a long period of time. In Singapore, we have unemployment rate that has also gone up, but has been improving in the past couple of months. But I think it's also quite high. So I think central banks would tend to be, if they look at just this aspect, they would be more dovish. So I think just to sum up, overall inflation is increasing. In the past couple of months, we have seen that it's been going up. Whether it's transitory, I think according to the central bank heads, it's more transitory. And then if we look at the US CBO, they also expect the prices to increase at a slower pace moving forward. Whether it will affect interest rates, they also look at job data. So if we look at the job data, it's improving, but there's still some way to go. So with that, I've come to the end of my part.
All right. Thank you, Dexter. So I've actually got a few questions to raise, if you don't mind. Actually, one of your earlier slides, if you don't mind going back, I think it's somewhere towards the front, where you actually talked about used vehicle prices. And you use that as an indicator of inflation. Could you just elaborate a bit more on why you're using this as an indicator?
Oh yeah, so I was actually explaining the reasons why we are seeing high inflation in the US. So if you look at the numbers here, it's 56% growth year on year and 45%. It's not exactly why we are pinpointing just these two components, but these numbers are actually quite high. So if we have an inflation number of 3.4%, and then part of it is driven by these very high numbers, so it's actually these two components actually skewing, in my opinion, the index higher, whereas other components of CPI is actually much lower. So overall, because of these high gasoline and high used vehicle prices, they may be the reasons why we are seeing a higher US CPI.
Okay. Yeah. All right. Okay, thank you for sharing. Another question that I have, and that hopefully answers quite a few questions for some of our investors also, because this is something that I think we get quite regularly. So some of our investors will ask us, like, why do we always refer to US treasuries when you're based in Malaysia, Singapore, or Hong Kong? Why do we always look at US treasuries, look at how they move, and how does that affect us? Can you tell us a bit more about this relationship?
Yeah, I think the US Treasury market is very closely followed. I mean, it's used to price US dollar denominated instruments, including US dollar denominated bonds. So many of these bonds are actually issued by many issuers in Malaysia, Singapore, and maybe Hong Kong. So many companies, including those in Indonesia and these countries, have issued these US dollar bonds. So if we are expecting US interest rates to go up, then I think the cost of issuing these US dollar bonds will be higher. So from an issuer's perspective, this would naturally impact the company's decision to issue US dollar bonds. And so instead of this US dollar debt, they may turn to other cheaper sources of funding, like maybe looking at raising debt in euros. So I think recent companies that have tapped the market, they've also been launching a euro debt, for example, a UOB. So as of now, I think US dollar, euro denominated bonds actually have very low yields. If you look at the longer tenors, they're actually trading at negative yield. So maybe from an issuer standpoint, it may be more cheaper to issue bonds in euros instead of US dollars. But yeah, I think so. That's the reason why most people look at the US Treasury. But the US Treasury market is pretty much a benchmark for US dollar debt.
Okay, thank you for helping us bring that into perspective. Before I let you go, I actually have one more question. I just wrote it down. Yeah, okay. So the conclusion that I'm getting from your sharing is that actually we're looking at a transitory sort of inflation. What are two indicators that we can use, our investors can use to tell them if this situation is changing?
Well, I think we can tell if the situation is changing. I mean, inflation is maybe going towards a structural change. If we still continue to see that central banks will continue to print money, interest rates will be low. The central banks will be very accommodative with their monetary policies. And then maybe the other two factors that would drive this would be on the demand side as well as on the supply side. So on the demand side, maybe, I don't know, maybe if wages continue to increase, unemployment improves, consumer robust spending activity, economic activity is healthy. I think these will be demand side factors that would lead to inflation, and possibly we'll see something that will maybe hit higher and maybe turn towards something that's more structural. And then on the supply side, if we continue to see low inventory levels, like low inventory levels of lumber, houses, supply shocks, border closures, manpower shortages, manufacturing supply chain disruption. So this would affect the supply side of the equation, and then these two combined together would naturally lead to higher inflation. And if it continues, we'll see more structural inflation moving forward.
Okay, yeah, that made a lot of sense. Thank you, Dexter. Okay, let's move on. So now that we understand, more about what's been happening with inflation, let's move on to Churan. So he's going to run us through the kinds of effects that rising inflation will have on the fixed income space. So over to you, Churan.
Okay, thank you, Sarah. So to look at the implications, first, we need to understand the relationship between inflation, Fed funds rate, and US Treasuries. So the federal funds rate, which is interest rate that depository institutions charge each other for overnight loans, is controlled by the Fed, while US Treasury yields are controlled by the market, as in through demand and supply, through purchasing or selling. So use of short-term USDs like 3 months US Treasuries are more affected by the Fed funds rate due to their shorter tenor, while longer-term US Treasuries are more volatile as they're more influenced by investors' expectations. So longer end US Treasury yields can also be thought as the expected path for short-term rates, plus some risk premium to compensate investors for holding on to longer-term US Treasuries. For example, your 2-year US Treasury can be seen as the path of interest rates for the next 2 years. So if investors think that US economic growth is going to pick up, yields may rise too. So how are they affected by inflation? So last year, the Fed changed its framework to the average inflation targeting framework. So changing of interest rates thus depends on historical inflation and the length of window for consideration. For example, the Fed may use 4 years or 8 years. Simply put, the Fed has an equation in which they feed maybe 8 years of data, and then they can determine the level of interest they want to set for the next month or maybe next quarter. But why do so many people focus on the Fed funds rate? Mainly because changes in interest rates can also lead to changes in expectations of inflation and GDP growth rates. So this chart illustrates the relationship between Fed funds rate, the 10-year US Treasury yield, and the US GDP growth rate. So the US GDP growth rate is represented by the white dotted line, which y-axis is on the right-hand side. And then we have the gray line, which is represented by the 10-year US Treasury yield, and then the blue line, which is the Fed funds rate. So as you can see from this chart, they tend to trend in the same direction together. When interest rates rise, US Treasury yields also tend to rise. And then it also usually means that the US economy is performing well and is growing. So, but then when you see interest rates rise, for example, in 2005, 2006, then you will see that the Fed is forced to cut rates shortly soon. So that's why there's the running joke of Feds raising interest rates causing recessions. So in the event of rising interest rates, how should we invest in bonds? So for that, we use duration as a guideline. Bonds with shorter duration are less affected by interest rates rise and vice versa. This is especially more so for developed market sovereign bonds because most of the risk is from duration risk. So in our examples, we will use US Treasury ETFs. Here we look at the 1 to 3 year US Treasury bond ETF and the 7 to 10 years US Treasury bond ETF. This table below shows the weighted average maturity and the effective duration. So for example, the 1 to 3 year Treasury bond ETF has an effective duration of 1.92 years. That means when yields rise by 100 bips, then the price of the ETF is expected to fall by about 1.92%. So short duration bonds are mostly driven by Fed funds rate. So as you can see, this white line is the Fed funds rate, which is inverted. So when the Fed funds rate increase, then your price of the US Treasury 1 to 3 year US Treasury bond ETF also fall. So if you look at the y-axis, you notice that the fluctuation in price for this ETF is actually quite small because of its short duration. So in this period, when the federal funds rate increased by 4%, the ETF only fell by about 4% too. But if you look at the longer term ETF, the prices don't really follow the Fed funds rates. As you can see, it doesn't really look the same as the previous chart. But then if you look at the y-axis too, you will see that its fluctuation is much higher. So higher duration bonds also have higher volatility because of its higher duration. So when 10 years use, for example, recently increased by 115 bips, then the price of this 7 to 10 year US Treasury bond ETF also fall by about 8%, which is roughly in line of what we expect from its effective duration. But what about corporate bonds? So usually we can split corporate bonds yields into the risk-free rate and its credit spread. So the risk-free rate is usually the Treasury yield, and then we can see that it will be affected by duration risk and credit risk, which is represented by the credit spread. So for highly rated bonds, duration risk still plays a bigger role because of its low credit risk. But for high yield bonds, credit risk is more important because its spread is much higher, thus it can compensate for its duration risk. So first we look at investment grade corporate bonds. I use another two ETFs here. We have the US aggregate bond ETF, which is majority in AAA rated bonds, thus representing very low credit risk. So for its risk-free rate, we can use the 10-year US Treasury yield because they have roughly the same weighted average maturity. And if you look at this graph over here, we can see that it correlates quite well with the US Treasury yield. But as you see, when US Treasury yields fall, the aggregate, this AGG ETF price also increases. So looking at high yield corporate bonds, we use the iShares iBoxx High Yield Corporate Bond ETF. It has 56.53% in BB rated bonds, representing quite decent credit risk. So for this risk-free rate, we can use a 5-year US Treasury yield because of its similar maturity. But then if we look at the price chart, the high yield bond ETF price chart is represented by the dark blue line. And then the US Treasury ETF price chart is represented by the light blue line. So you can see that they don't follow each other most of the time. And then when US Treasury yields decrease, you will see that the high yield bonds ETF prices actually drop quite significantly. It's because when economic growth falls, then your credit risk is higher, so they will fall in prices. So some clear observations. Rise in interest rate will result in short duration bonds falling in prices by in smaller percentages, as seen from the previous chart. And then long duration bonds depend more on economic expectations, for example, inflation, economic growth, rather than your short-term rates like federal funds rate. So investment grade bonds will also be worse hit than higher bonds due to their lower credit risk if interest rates rise. So for high yield bonds, rising interest rates may not necessarily be a bad thing. Rise in interest rates along with healthy inflation and economic growth could be a Goldilocks environment for them. So the Goldilocks term comes from the story where Goldilocks enjoyed her porridge, which was not too hot or not too cold. So similarly, a Goldilocks environment is when economic growth is not too high or not too low. So for example, when Fed funds rate rose from 2016 to 2019, credit yields remained relatively stable even as interest rates rose. This is due to the Goldilocks environment. So another thing is, if you look at the dark blue line over here, it is the credit spread of the US high yield bonds. So when during times of distress, for example, GFC or Eurozone debt crisis or oil crisis in 2016, or most recently the COVID-19 crisis, you will see that the credit spreads usually will spike up. So during these times of crisis, it's a very good opportunity to invest in high yield bonds, because when the credit spreads depress, then you will get price appreciation from these high yield bonds. Furthermore, in a Goldilocks environment, if we reinvest the yields, we can get a good capital return also. So if you look at this chart, it's basically the price return and the total returns, including dividends for the HYG ETF. So if you notice, this ETF was actually incepted in April 2007, which was the height of the subprime bubble. So that means high yield bonds were actually very, very highly valued. And then if you look at over these 14 years, its price of the ETF never recovered to its inception price. But then if you hold it all the way, you will still get a decent about 7.7% annualized returns, which is pretty good. Furthermore, if you look at the period between 2016 and 2019, even though interest rates are rising, the ETF price was also rising, meaning that high yield bonds were also performing quite well. But what if you invest when spreads are high? So instead of investing at the peak of subprime bubble, we invest almost at the height of the fail of the subprime crisis, which is March 2009. And then you'll see that this investor will have enjoyed 8.8% annualized returns over 12 years compared to the previous time when he invested at the peak of subprime bubble. So despite inflation fears or rising interest rates, investing in high yield bonds is still quite a sound strategy. So if you didn't catch a thing during my presentation, just pay attention to this slide. So firstly, rising interest rates will result in short duration bonds falling in prices, but in smaller percentages. Long duration bonds depends more on economic expectations, like inflation, economic growth, and unemployment rate. Investment grade bonds will be worse hit than high yield bonds due to lower credit risk if interest rates rise. And rise in interest rates may not be a bad thing for high yield bonds. So in a high inflation environment, we can look for companies that can perform well. For example, commodities firms, where commodity prices are higher, so they can earn higher margins. Or banks, when interest rates rise, then they can profit more due to higher interest rate, net interest margin, and companies that can pass down higher input costs, for example, REITs. So we also can look for companies that have the potential for compressing credit spreads. So when the credit spreads narrow, even though duration, their prices will fall due to interest rate, these compressing credit spreads will compensate for this duration risk. So with that, I come to the end of my presentation. Thank you.
Hi, Charan. So thank you for that as well. As usual, I have questions. So earlier on, you showed us a formula, right, with the risk-free rate plus the spread. Could you just go back to that? I think not everyone would be very attuned to formulas. But could you just share with us what does this spread here comprise of?
So credit spread can usually mean the credit risk or the risk that a credit ratings company may lower its credit rating on the bond. So credit spreads can be affected by macroeconomic factors too, like business cycles. So for example, when I pointed out earlier, during recessions, the credit spreads tend to spike up. Yeah, that's a macroeconomic factor. So credit spreads can also increase when default risk increases, or the bond has a high chance of moving down its credit rating bucket due to reasons like lower profits. So one good example, airline issuers, where the default risk increased when travel completely stopped last year. So the credit spreads fast increase because of the much higher default risk.
Okay. Fair. I guess that's fair enough. And then you mentioned that we saw a Goldilocks environment in the past couple of years, right? Like the idea of not too hot, not too cold, just the right temperature for porridge. So what about the next couple of years ahead? Could we be back to that again?
So actually, we may be in a Goldilocks environment already. So because of low interest rates and support from, for example, quantitative easing from central banks. So, but the question is, how long will it last? So for that, we have to see if the Fed is right about transitory inflation. For them to be right, we need to see supply constraints easing as labor returns, or supply disruptions like the transportation, all this is so that the price of goods will fall. So if they are right, there will be no rush to increase interest rates anytime soon at the expense of economic growth. So for example, they forecast late 2022 one rate hike. So this Goldilocks environment can continue as long as inflation doesn't pick up too strongly. So yeah, on the contrary, if high inflation sustained this year, for example, the Fed is blindsided, next few months we see inflation coming in at more than 5%, then we have fears of maybe economic growth tapering off because of Delta variants or maybe new variants or sustained lockdown. Then we will be a not so ideal situation where the Fed is forced to raise rates because of high inflation, but then economic growth is very low. So this will be negative for high yield bonds. Yeah.
Okay, then thank you so much, Sharon. So now that we have that, let's move on to the third question of the day. Right. So for bond investors who are already holding bonds or fixed income instruments in their portfolio, the question is now what? What are you going to do? The art to this isn't as easy as panic selling everything or panic buying everything. Okay, so now we're going to have Kiki to share more with us.
Hi, I'm Kiki from Hong Kong team, and thank you, Dexter and Sharon, telling us about our views on inflation and the implication across different credit segments. So I think most of the audience probably are bondholders, or you guys have some investment experience in bonds or bond funds. So maybe many of you will simply start to think about how inflation or interest rates could affect your own current holdings, right? Okay, so before we start our topic, it is important to know that inflation can have negative impact on fixed income assets when it results in higher interest rates. So if interest rates go up, then frankly speaking, bond investors who are holding longer term investment grade bonds will be more likely to result in falling prices. And it includes those bonds which are similar to the US 10 years Treasury bonds, such as bonds with very long time to maturity, maybe like 10 years or longer, and very low coupon rates and yield to maturity, let's say 1 to 3%, because these kinds of bonds are more sensitive to the changes in interest rates. Also, those investment grade perpetual bonds with fixed for life coupon payment will be very likely to see a drop in price, because perps don't have an exact maturity date. So once the issuer chooses not to call the bonds, there is no coupon set up or any other coupon reset features for such fixed for life perps. So you just keep receiving the fixed coupon rate payment, and then until the issuer decides to call. Okay, so let me explain why in a simple way. So firstly, you can see we have to know bond prices have an inverse relationship with interest rates. So this means that when interest rates goes up and then bond prices go down, so they move in opposite directions. And once you see here, once the interest rate rise and then the interest payment from the existing bond that you are holding actually become less competitive relative to those newly issued bonds which offer you higher rates, right? So that's why the price of the existing bond will drop eventually. Okay, so here I think it is better for me to show you an example. And let's say you are holding a treasury bond that offers 2% coupon. Then a year later, the market interest rates rise to 3%. And then so actually the bond you're holding just keeps paying you 2% coupon, right? And this makes it less attractive than new bonds offering 3% coupon. So the price of your 2% bond will be more likely to drop. So here you can see the bond are subject to interest rate risk because rising rates will result in falling prices. But okay, right now here, what we think about like this, we are actually holding a bond that offers us 5% coupon. So even interest rate rise to 3%, the bond we are holding is still competitive, right? Enough, right? And then so when you think about it like this, you can see in this example, we know that an increase in interest rates has a smaller impact on the bond with higher coupon rates, which means that they have lower interest rate risks. Okay, so after we understand this point, then we can talk about duration. When we talk about bonds, actually you may quite often to hear people mention duration sometimes. And actually duration is the thing that can measure the sensitivity of a bond's price to changes in interest rates. Let's say if the interest rates increase to 1%, a bond or a bond fund with 5 years duration would likely to lose approximately 5% of its value. So for a bond, the longer the time to maturity, the higher the duration and the greater the interest rate risks. And that's why we say those high investment grade long-term bonds would be more likely to drop more when the interest rate goes up, because it usually got a very low coupon rates and very long time to maturity. And then here, so right now, actually, we got some ideas how and why interest rates could affect our bond holdings. As we know, here, as we know, the bonds that offers higher yields and lower duration can lower the interest rate risk, and that's why exactly this high yield bond does, right? You can see here. So I'd like to show you this high yield bonds from different regions. And you can see the graph here shows the comparison of yield and duration from different high yield segments. And very obviously, from an interest rate sensitivity perspective, Asian high yield looks more attractive. And because broadly speaking, here you can see Asian high yields give you higher yields and with lower duration, which is the best option to lower your interest rate risk when investing in bonds. And okay, after you get this picture, then what we want to tell is that at this stage, we think bond investors need to be aware two main risks that can affect bond investments value, and they are credit risk and interest rate risk. As we just discussed how interest rate risk can affect our bond investment, you surely know bonds with lower yields and longer duration face higher interest rate risk rather than credit risk. So apart from interest rate risk, a bond's investment value also affected by credit risk. In general, high yield bonds have higher credit risk than investment grade bond, of course, As you know, high-yield bonds issuers have low credit ratings, and that's why we call them non-investment grade bonds. This somehow shows implied that credit quality is not that good compared to investment grade issuers. So the risk that the issuer might be unable to repay the principal or interest to its bondholders are usually higher. So if you tell me you are holding short-term high-yield bonds, you actually face more credit risk rather than interest rate risk. And finally here, what we want to tell bond investor is that you shouldn't be too worried about it, because really, if you intend to hold a bond to maturity, it is really true that the day-to-day fluctuations in bond prices may not be very important to you, although the bond prices may change, but you still get paid off the interest payment, right? And get back the principals of the bond at maturity day. And of course, actually, instead of holding the bond to maturity, actually you can just sell the bonds in the market and do reinvestment. So you can reinvest your money to another bonds that pays you higher yields. So yes, I hope my answer can help to solve this question.
Thank you, Kiki. Yeah, I think that was a really helpful summary. I really enjoyed how you broke down the concepts. It made it a lot easier to understand. And I think it also addressed some of the questions that were raised in the Q&A, although I think Dexter answered some of them already, but this was the verbal version of that. So on your last point, I think it's also important actually for investors to just take note that, in most scenarios, higher returns mean having to take on higher risks. So investors should also make sure that they understand what they're buying into while similarly applying these concepts to how inflation will impact your next purchase. And I think I saw this question, let me just pull it up from the Q&A, where someone asked, when inflation surpassed bond yields, loss of capital if you were to sell in the secondary market, forced to hold to maturity with lower yields against inflation rate, I think bonds, you have to be selective now. And I think the person, the person asking the question described it very clearly, and I think you also answered that very clearly. So there's another question that I want to ask. Okay, so in one of your previous slides, you mentioned that for fixed for life perpetuals, you're gonna likely see a drop in prices. The thing is though, I recall that a few weeks ago, Cheong Kong Infrastructure actually issued a fixed for life perp. And I mean, well, most recently, Mapletree as well, but any insights on how the Cheong Kong bond actually fared with investors? Did people want to buy it?
Yes, you're right. It is CK Infrastructure, Cheong Kong Infrastructure. So actually, it issued two new perpetual bonds in May and July this year, and its coupon rate was like 4.2% and 4% respectively. Actually, I can't remember the latest one, but the perps issued in May were oversubscribed like 3 times. Actually, I think like other perps, actually they are callable at par at the end of 5 years and on every distribution day hereafter. So with the fixed for life perps, as there is no coupon reset and coupon margins if the issuer chooses not to call, they are less likely to call the bond at any time. Because you can think about it from the issuer's point of view, this is perfect to keep such debt, cheap debt forever actually. Because if interest rate rise in the future, I can try not to call and then just keep this debt. And I think we can take one of its perps, which has been called for an example. So in 2018, the Fed raised 4 times during the years, and the price of that CK infrastructure perps dropped from about par like 105 to about 90 during the period. So you can see, like what we say, the perps are really quite sensitive to the interest rate changes.
Yeah. But Kiki, like how often do we see these fixed for life perps? most of the time when I look at them, I think they usually come with like a reference, like a reset rate and reset date, right? So how often does this fixed for life thing come about?
Yes, actually, it's quite often to see. Many companies, they do issue perps regularly to do refinancing. And perps with high grade and well-known issuers such as banks like HSBC, Bank of China, and some big names corporates, of course, like CK Group, AIA, and so on. They are quite popular actually.
Oh,
I can't say, yeah. All right. So I can't say most perps typically come with coupon reset or coupon step-up features, because not all perps are created equal, right? And then they may look similar on the surface, but the underlying covenants and structure can be quite different. And this may affect the bond's performance under different market scenarios. So normally we do see issuer decide to call their perps on the first call day to avoid any reputational risk in the market. So because they still have ongoing needs to access the capital market, but it might be only applicable for some frequent borrower and who really worry about this, because honestly speaking, even when there is a coupon step up after a call day, investors are better to assume that the issuer may not call the perps if its coupon step up is not that much. So what we have to remind investors is this point. Like a perps comes with 100 bips step up, but sometimes actually paying 100 bips or more in coupons might be still cheaper than issuer to issue new bonds. Yes.
I see. I see.
Yes,
Well, thank you for that introduction to perps, actually.
Yes.
So now let's move on to our final speaker for the first segment. Jackson will be sharing with us some geographical segments and sectors that he finds attractive at this point. And he's going to do all of this while taking the possibility of rising inflation into consideration. So Jackson, over to you.
Okay, thank you, Sarah. So this is Jackson Chen from Bond Supermarket Hong Kong team. So today I'm going to answer the question that I think most of you may be most interested. And the question is, what is attractive right now, and what should I buy for in the second half of 2021? So previously, I think Dexter and Truran and Kiki has already shared quite a lot of views about our macro house view on current macro backdrop, which is we think that the Fed is likely to start tapering under the inflation concern, and we think that it will pose an upward pressure on the Treasury yield. So given this scenario, we actually think that the long-term investment grade bonds are still facing higher interest rate risk. So on the other hand, we think that with lower interest rate sensitivity, the high yield bond should perform better. So in simple, what should I buy? So actually, this is a very interesting question because some of the investors, they really like to invest into investment grade bonds. But at this point, we think that they should be more careful when buying into those long-term investment grade bonds. So unless the investor intend to hold until maturity, otherwise, they should be more careful about it because of the interest rate risk. But on the other hand, if they are buying into some kind of, for example, 1 to 2 years investment grade bonds, and they are just looking for maybe, for example, a 2 to 3% yield to maturity, and they will not sell it, and then we still think that this investment grade bonds are okay. But on the other hand, if you think that the long-term investment grade, if you are thinking about the long-term investment grade bonds, and then you should be more careful. So furthermore, we think that with the narrowed credit spread as a result of the economic recovery, the high yield bond should continue to outperform. So as you can see in the chart in the right-hand side, the blue line is the US IG chart, is the US investment grade bond yield, while the yellow line is the US high yield bond yield. So you can see these two trends has a completely different direction. So over the past year, actually the high yield bond continues to outperform the investment grade bond. And under the macro backdrop of the interest rate hike, we still think that this scenario will continue and the high yield bond will outperform. So when we talk about high yield bonds, we have to understand that there are many different choices in the market. And therefore, we think that it is better for us to classify this high yield bond into different geographical locations. So in the chart below, you can see actually we define the high yield bond into 4 different categories, including the US high yield, the Asian high yield, the emerging market, as well as the European high yield bonds. So generally speaking, we think that Asian and emerging market bonds are more attractive because they are offering higher absolute return and also risk-adjusted reward relative to that of a US and the European bonds. So why do we think about this? Maybe some of the investors may argue that because they may have higher risk and therefore they could offer higher yield. But in the following part, I will explain why that we think the risk-adjusted reward for the Asian high yield bonds is attractive to the investors. So when we mention about the Asian high yield bond, we must mention about the Chinese real estate sector, mainly because that actually the in most of the Asian high yield bond index, almost 50%, which is half of the index, is composed by the Chinese real estate high yield bonds. So that's why we have to mention about the Chinese real estate sector at this point. So I think many of you may have already heard about there are many news surrounding this sector, and this sector is under the spotlight once again. And actually, yes, we do see that the Chinese real estate sector continues to face the tight regulations under the direction of the houses are built to be lived in, but not for speculation. So many different buy and sell limitations are imposed in the major cities across the country. And the regulators also implemented the 2 red light policy on banks, so targeting the real estate loans, which the banks are limited to borrow their money to the house buyer as well as the developers. So in addition, we also see that the central bank's monetary policy is pushing the mortgage rate up for consecutive months. So although we saw that in last month, actually the central bank has lowered their required reserve ratio, which demonstrates actually some kind of loosening signal for the monetary policy. However, we don't think that the government will want the mortgage rate to go back down. Instead, they are trying to raise the mortgage rate across the country. And we think that it will definitely affect the market demand of the house buyer to a certain extent. On the other hand, we also see that the financing channels of those property developers are also restricted. So because the government tried to force those developers to deleverage, we see that many developers, they are required to maximize their cash flow by lowering the price in exchange for volume. So the overall profit margin is being pressured. As you can see in the chart below, at the end of 2020, the average gross margin of these developers dropped to around 25%. So in previous years, we always say that the average gross margin for those developers is 30%. But right now, we don't see this situation. This situation is going to happen again, and we think that the overall profit margin will further go down in the next few years because of those big discount promotions. However, despite those some kind of negative news or regulations that I have just mentioned, we still think that the Chinese real estate bonds are worth the attention because we think there are some kind of crucial factors that can actually is more important to investors, which is including the sales amount and the sales growth, the housing price, and also the individual issuer's credit status. So let's look at the sales amount first. We saw that the national residential sales amount increased by around 42% year-on-year in first half of 2021, which is a very strong growth. And we think that it is highly possible to reach the double-digit growth that we forecasted earlier this year. So besides, despite the increasing regulations, we also see that the housing price is still resilient. So according to the National Statistics Bureau, the 70 large and medium city housing price index has been increasing stably for over 69 consecutive months. So while the average month-over-month growth in 2021 has reached 0.5%, so we think it is a very healthy number at this point, and we think that the government is also and we also think that this number is what the government wants to see, and under the direction of stabilizing the housing market, we think the current numbers, for example, the sales growth and the housing price, is actually what the government wants to see, and they will not interfere a lot in this perspective. So when we talk about the individual issuers' credits, we have to look into their actually the credit status as well as the deleveraging process. So actually we see that the deleveraging results in the Chinese real estate sector is remarkable. So more than 90% of the developers have reached the yellow light or green light categories under the latest free red light regulations. So in the table below, which shows the net gearing ratio, which is actually the net debt to equity ratio of the top 100 developers in China. So you can see that the leverage ratio for this developer has improved a lot at the end of 2020. So it is very remarkable and quite impressive in our point of view. So since January, the Chinese real estate bonds are being pressured by several credit events involving companies like the China Fortune Land, China Huarong, Languang Development, and also China Evergrande. So we saw that the B-rated bond yield has exceeded the highest level in last year. So the yellow line you can see is the single B-graded bonds. So the yield is at an extremely high level right now. And we also see that the double B-graded bonds also have their yield increased quite a lot. So with this increasing yields, we believe actually there are more and more investment opportunities have emerged. So especially we think that there are some companies who are dragged by the sell-off in the entire sector, but actually they are not having any deterioration in their own credit. So we think this kind of companies and this kind of issuers are actually an investment opportunity for investors. But at this point, we also think that selecting suitable issuers become more important. So yes, and that's the end of my sharing today.
Thank you, Jackson. So we've got quite a few questions coming in for you actually.
Okay.
But first, if I conclude correctly, your two main suggestions here are Asian high yield and the Chinese real estate sector. Is that right?
Yes, all right.
Perfect. Yeah. So we just saw a question earlier asking about your thoughts on emerging market high yield. So I remember the slide earlier you showed, right? It was the geographical regions across the chart, and you had emerging markets EM high yields next in line to Asian high yields in terms of spreads. So could we get your view, me and the person who asked in the Q&A earlier, could we get your view on whether EM high yields still look attractive at this point as well?
Sure. Actually, I think many of you already know that Asians actually plays a very big part in the emerging market sector. However, the emerging market also includes a country like Brazil, Mexico, South Africa. So although they also offer higher yield compared to US and European bonds, however, they usually look less attractive because of few reasons. The first one is very easy to understand, which is those companies are not quite familiar to Asian investors. So it is harder to find sufficient data and analysis to really comprehend this company's credit status. So second, when we compare to Asian high yield, the emerging market high yield bonds as a whole actually generate a lower yield relatively given the same credit rating. So last but not least, the available choices in this non-Asian emerging market bonds are not much. So for bond investor, they will find themselves more difficult to invest into this category.
I see. Yeah, I think that's a very fair point. I hope that answered whoever who asked the question earlier. And now let's address the elephant in the room, because we're getting quite a few questions on this as well. Essentially, Evergrande. Okay, so we're just gonna touch on this a bit. Evergrande has continued to attract a lot of attention from the news media and the reports about its ability to keep repaying its debts. And you've written 4 updates already, right? I think at this point, has it been 4 updates? Yeah, 4 updates in like the past 2-3 months. So the thing is, as we know by now, the whole ecosystem is somewhat linked to another. Okay, you cannot have a company going belly up without affecting others, right? So in this case, given the size, the significance of Evergrande, if something were to happen to it, what other repercussions could we expect?
Actually, the impact is already here. And that's why we saw the yields of all the Chinese real estate high yield bonds going up in the recent months. And indeed, at the current yield level, it becomes almost an impossible task for some highly leveraged developers to refinance the debt using some kind of traditional debt financing channels. So we do have to wait until the market confidence is restored. But if we just look at the Evergrande case alone, we think that the impact is still manageable, even if Evergrande goes down, because most of the banks have to do stress tests and also manage their risk exposure to any individual borrower. So we believe it will not trigger a systematic risk in the Chinese financial system, especially currently we think that the government should already ask all the banks to check their exposure to Evergrande. So we do not think it will trigger a systematic risk or a systematic storm in the whole market. However, we still think it will definitely affect the overall bond market, especially the confidence of the offshore bond investor.
Thank you for that. I hope that answered some of your queries as well. I'm going to move on from Evergrande for now. So I know a lot more people have questions on Evergrande. I'm seeing a lot of questions like, is this going to default? So let's go into more detail on Evergrande later during the Q&A. So anyone else who has questions on Evergrande, please send them through. And we'll get to them during the Q&A, okay? So for now, I'm just gonna move on to my next question. So I want to touch on Chinese real estate, right? So the Chinese government, they recently issued some newer measures in regulating industry, things like having your state bank raise mortgage rates for home buyers, having the state banks trim home loan exposure, and coming out in general just to say that they're not going to use the property sector as a short-term tool to stimulate the economy anymore. So how do you feel about all of this?
Actually, there are many different policies coming out in China almost every month. So especially the reason we saw that the tax stock crackdown that is triggered by the fears in the market due to the political risk in China. So while that is actually the time that we have to remind the investor or remind ourselves why we think that the sector is attractive. Which at the end, we think that we have to go back to the fundamentals. So such as some fundamentals in the Chinese real estate sector, such as the sales growth, the housing price, and also the cash flows of the individual issuers. So as long as these indicators are healthy, we think that the developers should be more capable of repaying the debt. And the bonds will look attractive, even if their earnings declined or the companies are affected by the policy.
Okay, well, that's all the questions I have about the Chinese real estate now, but I'm sure now that we have our expert here, more questions about it are going to come through. So thank you for that. And with that, we've wrapped up our first segment. We've asked the whys, the whats, and the hows. And now that all listeners have that background, what's going on, we want to move into our next segment, which is our recommended bonds, okay? So each of our analysts here today, they have prepared 2 bonds that they're particularly keen on. They're gonna share with you what the bond is about, why they like it, and why they think it's an attractive investment. Okay, so up first, we have Dexter. So over to you, Dex.